once again to Retire Your Way with Ben Heizer, powered by Thrive. Also joining us today is Matt Tucker, CFP, part of the management group inside the investments and everything that we're doing here at Thrive.
Yeah.
Good to see both of you fellas. Ben, how are you doing this week?
I'm doing fantastic, Spike. How have you been?
I'm good, good. Can I please explain a little bit, if you don't mind? Matt, great to see you here. Loving the carnation.
Thank you.
We've got to talk about market volatility, fellas. We have to address what's going on, and I think that's why you brought Matt in today.
Let's talk about Matt for a second. Can I brag on this guy? Okay, let's talk about Matt. Look, it's not just me out here at Thrive, okay? So we do have members of our team. So Matt is actually a certified financial planner. So he's done some additional schooling. I like to call him a ninja and or a baby genius, whatever you want to go with, he likes. And so Matt, he is here because we're going to be talking about some important topics today, things that I find as I meet with folks, and Matt and I meet with them on a consistent basis, that they don't know. And they don't really realize the differences between what they can do, right? Passive models and active models and different types of areas where we are subject to risk, and risk can really impact our retirement savings. And so Matt is here. We're going to let him have some conversations. It's not just about me, it's about our team, and we're here to help you thrive.
Matt, would you mind explaining a little bit of that?
Absolutely.
So you help with the investment strategy here at Thrive?
Sure.
Is that with individuals or looking more at modeling? Can you explain a little bit for the viewers?
So that's actually one of the reasons I came over to Ben's team, and I worked for a large corporation, one of what we call our, the big box firms, and I just really wasn't feeling as fulfilled. They only did really one thing, and it was really more growth oriented, your money in the market. I like Ben's approach where he takes all different approaches to your areas of retirement, your 5 strategies, whether it be growth, income, taxes, so on and so forth. And really what I help with is the growth and accumulation part of it. How do we achieve that long-term growth that's necessary to have a successful retirement?
It's interesting you say that, and so I want to continue to highlight that. I'm going to sew this all together. We're going to be talking about market volatility because we know it is pressing on people right now. The markets have been, depending on what time this air shows, 20 to 25% down throughout the year. We don't know where it's going to go throughout the rest of the year, so we're going to talk about investment strategy. But when I say sewing it together, because you just said growth, how much growth is appropriate for somebody who's going into retirement? And define growth, if you don't mind.
Yeah, well, I mean, people have different goals. So some people are looking for safe growth, and some people are looking for, a little bit more risk. So if they're okay with taking risk, it's more about long-term growth. And so what Matt and I do is we kind of take a look at, different areas of that. And so we kind of, like we've talked about it before, we kind of take someone's portfolio, plug it into the computer, and it spits out data for us that tells us how quickly someone's traveling in their portfolio. If you're traveling too fast, you could be taking too much risk. If you're traveling too slow, you may not be making enough return to keep up with things like taxes and inflation, and all of these are important. So growth is a critical checkpoint on the Retire Your Way roadmap. And Matt and I here as your guided personal solutions. We're here to help you retire your way and accomplish your goals and dreams. But I want to have Matt address a couple things here, because I feel like as we sit down with people, they don't fully understand the difference between like a broker, an advisor, and a money manager. Matt, can you explain the differences between those for our listeners out there, so that and how we use money managers a little bit differently?
Sure. So great point. So a broker, Ben and I I like to have this joke that says sometimes your broker is actually end up making you broker. Not always the case, and everybody gets paid a little bit differently, but the broker model is they're going to affect fees on transactions, in and out, back and forth, or like anything that they would sell you, they get a commission on. As financial advisors, as fiduciary advisors, we work a little bit differently. So it's a percentage of the total assets under management. So that we're then incentivized to then obviously see our clients' portfolios grow. So it's a little bit of a different fee structure.
Right, and I wanted to know, I just want to go to that to make sense. So you're saying that, of course you want your clients to make money.
Sure.
When you're saying fee-based, so it's based on the assets that are there, which also means in times like today, if the markets go down, you actually make less, because you can't help the fact that the markets went down, so therefore you take a haircut as well, and that way you're both rowing in the same boat, right?
Exactly. But it's also important to, not only is that true, but we're also trying to do things and employ strategies to hopefully mitigate that down. And that's also why that incentive is mutually beneficial for us and our clients as well. And that's only one part of it. You know, that's one part of the things that we do for people. The things that we have available for income are completely different. They may not have a fee associated with that at all. So I think that's important to have a comprehensive financial plan and see what works for everybody, because it's going to be different.
To simplify things, what I like to do is say, hey, there's really kind of two models here. You have passive and you have active, right? And I want you to think about us like driving a car. Okay, passive models in the market, right? You stick your money in and you're putting dollar cost averaging, but you're just following the trends of the roads, the ups and the downs. And so depending on how fast you're driving will depend on how deep those depths are, right? And how high the highs are. And so how much volatility can you stomach on that roller coaster, if you will, of the market? Now, outside of that, there are active strategies where that's where these money managers come into play. And so, you know, what we've been fortunate to have is, you know, chartered financial analysts on our team like David Young, who go out and he builds portfolios that are custom tailored, different than your big box companies that are trying to have something that's available for everybody that's passive. And so what he's done is created different things. Now think about this. There's different types of cruise control in your car. You have passive cruise control. You're reacting to the environment of whatever's happening, right? There's no protection. And then you have adaptive cruise control today. You pay a little bit more for that feature, but guess what? It automatically slows you down when there's risks ahead, and it speeds you up when the coast is clear. Isn't that what we want? Mitigate the down, maximize the reward. That's where strategy comes into play, and having an active portfolio is so critical.
And also what you do with Thrive, though, is the kind of cruise control that I like, where I sit in the passenger seat and somebody else does the driving for me. That's what you do for the folks here in Chicagoland. Please tell me a little bit about the complimentary review. We know that there's a QR code at the bottom of the screen. That's the confidence quiz. I love that.
Yes.
But when they call in for the phone number and you're going to talk to them about the Retire Your Way system, what exactly would that cover?
Well, if you're concerned about risk right now inside of your portfolio, give us a call, 855-855-7655. There's two things I want to ask. Number one, do you know your custom risk speed? If you don't, then you don't know how much risk you have in your portfolio if you don't know how fast you're traveling. Number two, have you been told the maximum drawdown inside of your portfolio? If you don't know how much it's lost in the past, how do you know how much it can continue to lose? Look, if you're losing money right now, we want to put a tourniquet on that and stop that, add strategy to it right now to the fundamentals that you have so that you can mitigate that risk and maximize the reward. So if you call the phone number, 855-855-7655, complimentary risk review will evaluate the needs that you have, and then that could be part of an entire plan of the Retire Your Way system to help you thrive in retirement.
Matt, do you mind coming back after this segment break right here?
Absolutely.
All right, we're going to talk more about investment strategy with Ben and Matt when we get back right after this break. I'm actually going to ask them how much should they be in the markets if you are retired. But do yourself a favor, get started on that complimentary review. First 10 callers, Chicagoland, 855-855-7655. More Retire Your Way with Ben Heizer and Matt Tucker when we get back right after this.
I started the practice wanting to protect people's assets. As we've grown over the years and we've added different services and our team has grown and our team of specialists have grown to serve our client base, we've outgrown just me as a singular individual. It's not just about me anymore. So we just rebranded, came up with a new name. Yeah, we were Heizer Financial Group. Now we're Thrive. The logo that we've designed has so many neat things that are involved in it. It starts with a circle, and that means something to us. Trust is important. You know, just like a commitment that I make with my wife, you know, we have the circle that it begins with. And so our clients are entrusting us to help them maximize and thrive with the wealth that they've created. The other parts of the logo are pretty neat. There's a handshake right in the middle, because we're working together, and this is a mutual agreement of what we are trying to accomplish. And then lastly, there's pillars of growth. We always want to see things grow. We want our lives to grow. Thriving is all about, you know, prospering in multiple areas, mentally, physically, spiritually. We don't want you just to survive. We want to help you thrive. I'm Ben Heizer. I'm here to help you retire your way, powered by Thrive.
Thank you so much, Chicago, for coming back to Retire Your Way with Ben Heizer, and today with us, Matt Tucker. I'm your host, Spike Spengel, and we're talking about the market volatility. One of the reasons you're here is because you help with the actual money management of what's going on. And I've got to say, moving into retirement, the strategy has to be completely different because you're no longer obviously getting an income. You might start Social Security eventually, but you don't have those matching funds coming in from your employer, but also you have the volatility of the ups and the downs of the market, which is what's happening right now. It's scary for folks. How are you helping people feel comfortable?
That's a great point, and it makes a difference when you're actually approaching retirement. It's a completely different ballgame than when you're saving for retirement. When we're saving, we're in our accumulation phase, we're in growth mode. A lot of the money we sock away is growing. We're taking advantage of when the market is down, buying at low opportunities that it'll increase when the market rebounds and picks up. As we approach retirement, it starts to look a little bit different. We don't have the time on our hands to recoup those losses that we might be experiencing, and we might not be contributing as much at that point in time. I say to Ben, you know, a good general never goes into battle without a good exit strategy, right? That's what we have to start planning for as we're approaching retirement. How are we going to start protecting a little bit of that money so we don't lose as we're going to start preparing to start taking income or start drawing down from these assets that we've done such a good job of accumulating?
Right, and at this point, with the markets being down, for retirees who don't want to have to go back to work, it's almost like doubling down on how much money is coming out, because the market, there's a certain phraseology. I'm wondering if you can explain it for the viewers.
Well, losses affect us differently in retirement than they are where we're working. So to piggyback off of what Matt's talking about here is when we're working, we're accumulating our wealth, right? We're saving, we're using dollar cost averaging. If our employers are matching us, they're adding additional funds to our portfolio, and it allows us when we go through a downturn to recuperate quicker, okay? So when we don't have that anymore in retirement and we're spending our money, we're using it as an income stream, losses affect us in two ways. They affect us, obviously, in the value of our portfolio, but more importantly, in the years of income that we have. So if we're supposed to live off of the rule of 4, right? 4% of our portfolio adjusted for inflation every single year. The challenge of that, if you look at that in the market, is if we go down 20 or 30 or 40%, you just lost anywhere between 7 and 10 years of your retirement income because we're not saving anymore. And that can be evaporated as we're spending money. Because when do you lock in losses in the market? Not when it's accumulating and we're not touching it. It's when we're spending it that makes the biggest difference. And that's why the strategy has to shift. But sometimes we get stuck in the old way of thinking, and it has to change. Otherwise, it could really impact your life.
Well, something I wanted to ask you both about, first of all, is how much should a retiree be in the markets at all? You know, there's a lot of folks who might say, I don't need this kind of investment strategy right now. I need to move over to safety. But you both put together, as you said, very individualized plans for each person. I have to say, I find that hard to believe. With hundreds, if not thousands of clients, how do you devise a specific strategy for each one of them?
It's a great question, but it's a very, very one with a simple answer. Your financial situation is going to be different than ours, different than Ben's. And everybody has different assets that they've accumulated, and they have different needs in retirement. So you said how much money should be in the market? Well, that really depends. Right. Is the client comfortable? Are you comfortable with the risk? Do you know, speaking of that roller coaster that we were talking about earlier, I personally still like roller coasters, so I have a good time. Ben doesn't like them so much. Yeah. So if you're comfortable with those types of risks and you can take that, the volatility that comes along with it, as long as you know what the expectation is, some people just don't like it at all. And I would say those people probably shouldn't be in the market if they're going to bail on that strategy, if they're going to sell when it's, I've lost too much, I can't do it anymore. They're compounding their losses. And like Ben and I talk about, when it's in retirement, losses can hurt you more than gains will help you.
But to talk about this, and this is why it's so critical, folks, to have a bucket strategy to your money, right? We have our money for growth. And then by employing strategy, you're comfortable with the volatility because you know that that's designed for growth, not short term. This is a marathon, not a sprint. But then we have money designed for our income. So how do we do that? Again, we look at your goal. What's your dream? What do you want to accomplish? What do we need to spend money on outside of our fixed expenses like travel, right? Spending time with our family, RVing across the country. What does your dream look like? What do your goals look like? And then once we understand what that number is, we can fill it with accounts that are designed to give you not only guaranteed, but increasing income to keep up with taxes and inflation concerns. So you can let that market money breathe and grow. And by having different buckets for our growth and our income and our emergency cash, you're not stressed about what your money's doing because you have a plan with it.
Right. I do have to ask you about, though, market volatility. Let's hope that right now our viewers are also sitting next to their spouse, right? How often do you see spouses with different market volatility risk tolerance? I mean, there's got to be couples out there, right, where you've disagreed on how much you should have in the markets. And with the downside of what's going on right now, there's probably some disagreements right now on how much. How do you help solve that with couples?
Well, let's talk about that. So the first thing that you have to know, and that's what Matt and I do, we take a custom risk assessment to understand a risk speed between 1, which is the most conservative your vehicle can travel in the market, and 99, which is the most aggressive. And when we do that, we do it with husbands and wives so that they are bantering back and forth and they can find a solution in between, because the strategy is we don't want to be reactionary. We want to be able to stick to a strategy long term. And why is that so important, Matt, for someone's long-term health on their growth money?
Having that strategy is essential for that, because they need to be in agreement. You know, we actually do come across couples that one might be a lot more conservative actually than the other, and it's not right, wrong, good, or bad, but we need to come to a solution that they're both going to be comfortable with, because it's ultimately going to affect them both.
Right. I mean, it's like going into a baseball game or a football game or anything like that without having any sort of plan whatsoever, which is what half of our teams look like most of the time on the field. But sorry, Chicago. But when we have this plan put together, even if we're a little bit off, this is why I like you guys talking about it, because the word having a financial plan, or, you know, that phrase and so forth, we hear this a lot. But not knowing how much we can spend every single month, should we be doing things like Roth conversions? What is our medical strategy? That's when I think people stay up at night, because they don't know. I think you've said that before. One of the biggest fears is, am I going to be okay? Meaning, am I going to run out of money? And that's what putting a plan together, actual written strategy, helps with?
And the biggest thing too is the more we lose, the more returns we need to break even. And so back to your point, a husband and wife, you might want safe growth. Well, you can get safe growth in like a 4 to 6% space right now. So if that's comfortable for you, awesome. If you're a type of person that you want to get 6 to 9 to 10%, you're going to have to take a risk to do that, and you have to be okay with how much risk you have. So here's the thing. If you're out there thinking to yourself, I don't know what my risk speed is, Ben. I don't know what my maximum drawdown is. I don't know how much risk I have in my portfolio. Do I have too much? Do I have too little? Let's sit down and take a look at it. We'll build a custom tailored retirement plan, custom around what kind of risk do you want? Do you want safe growth? Do you want market risk? We can take a look at those things and see how they impact you as a whole. And that's something that we do with our customers. That's what the Retire Your Way system is designed to do, is bring you success in retirement by addressing the 5 critical areas: growth, income, taxes, healthcare and long-term care, and of course, legacy. We'll help you accomplish your goals and retire your way. Powered by Thrive, but it starts with you. Pick up that phone at 855-855-7655. That's the number to call. That QR code is a confidence assessment. It'll give you an idea. You can visit thrivewealthgroup.com to schedule an online appointment as well. Folks, write this down. Back to Spike.
Ben, Matt, we've got to take a very, very quick break. But like Ben was just saying, please make sure you get your complimentary review. We'll start you on your own Retire Your Way plan. The first 10 callers, Chicagoland, obviously this is broadcasting all over the place, going to hundreds of thousands of folks. So the first 10 callers, you get your own complimentary Retire Your Way plan by calling 855-855-7655. More with Ben and Matt when we get back right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to Retire Your Way with Ben Heizer. Also joining us today is Matt Tucker, both CFPs working in making sure that you have your own retirement strategies in place. And we've got to, unfortunately, keep talking about the market volatility. It's really spooky out there right now. What are some of the other obvious downside effects of taking money out when the market is down?
Well, yeah, Matt, if you want to take that one, let's talk about it.
So I think the biggest concern you have when you're approaching retirement is it's something called sequence of returns. So if you've saved all this money, the market's been great, and you just stop working and are just going to start drawing from your portfolio. What if it was this year when we experienced, a 15 to 20% year where we're taking down? Well, like I said, the firm that I came with, their solution is, well, you got to spend less, right? Because the market's down. Well,
great. I guess we're all taking it. We're all on a diet.
Folks, let's just recap what Matt just said, right? So often the advice you're going to get sometimes from a big box company is, hey, the market's down 20%. What do? Well, you got to spend less. Is that what you want to do? What 20% of your lifestyle do you want to cut out in retirement that you've worked hard for to accomplish? Okay, back to you, Matt.
No, that's exactly right, because when it's down 20%, the only thing we can do is if that's where that sequence of returns comes in. If we're also pulling our income at the same time the market is down, we're compounding our losses there, right? So we're taking even a bigger chunk while the market's down, and it doesn't give us that time. But if we get lucky and the market's up, then great. Yeah. But how do we plan for that? That's what we're talking about.
Exactly. Well, that's what I'm asking. So is this tools? Is this other, as you would say, Ben, buckets of money that are outside the market? So you've got multiple different areas, the kind of diversification that really means global diversification?
Yeah, let's talk about that. So, I mean, there's different custodians out there that hold our money, right? We got, broker dealers, we got banks, and we got insurance custodians, and they all have savings accounts, and the names are what they are, okay? At the end of the day, the market is designed for long-term growth, right? It's very liquid. Can we use it for income? Yes, but what Matt's talking about is sequence of returns. It's a fancy word for saying order of returns. If the order of our returns goes negative, what we can chart out is someone that had enough money for retirement that ultimately runs out, okay? If it just starts out in the negative. Well, where are we at? We've been high for a very, very long period of time, and this is some of the concerns that leave people there. So all we can do is employ strategy in the market to mitigate risk. We can't eliminate it actually in the stock market. So what we can do is we can use other asset classes, right? Things like, let's say like a fixed indexed annuity, right? This is great for some people and not for others. Annuities are savings accounts with insurance companies. Let's talk about how they work. They give you like 60, 70% of the upside with none of the risk. So it's like going to the casino. You get to play the game. When you win, you don't get all the winnings, but when you lose, you don't give any of them back. That's how your money grows. But that's at an insurance custodian, not at a broker dealer. Flip side of that is these products are designed to give us guaranteed income. And what we do as an independent financial firm is we can shop everybody. We use technology to do this, and we can sit there and go, here's all the different annuities if it's something that you want that gives us a guaranteed income. Do you want it to be level? That means the same for the rest of your life, or do you want it to increase to keep up with taxes and inflation? Now, most people pick that one because they don't want to compromise their lifestyle, and we don't want you to shrink up and survive, folks. The company name is Thrive, not Survive, okay? So we need to make sure that you're thriving through retirement, and we do that by employing the Retire Your Way strategy to make sure your money's in the right tool for the right job, for the right need.
Let me ask you, fellas, again, you help with the money management, taking a look at the complexity of what's going out there. For people in retirement, both of you do. That's what the firm Thrive does right here in Chicagoland. Offices all over the place. Call the phone number you see at the bottom of the screen there for your own solutions. But I wanted to ask you, with this market volatility, and by volatility, I mean the downside, is there anything positive? Is there anything that we can do proactively right now because the markets are down?
So the one thing you know about the market is eventually over time it goes up, right? We're in a rough period right now, and we have, like I said, we work with multiple different money managers. Some of them are a little bit more conservative right now. Others are rebalancing, almost like doing what you would do every day in every week in your 401k, is adding additional money. So when the market's down, you rebalance, sell some of the things that are maybe have been up a little bit more and purchase those things that are, we always know that old phrase, buy low, sell high.
Yeah.
Well, that's what we do inside those portfolios, is that active rebalancing strategy. We can take advantage of that within the portfolio itself. So at times like this, we are buying at the low so that when the market, if and when it does come back, which it will, who knows when.
So for those who can stomach the roller coaster,
Exactly.
the market is 20% on sale right now.
Correct.
Now,
Yes.
but you're also saying you want to sit down with a professional and evaluate this, because we're not telling everybody to go out and buy, everybody to go out and
Correct.
sell, or everybody to hold.
Well, Spike, here's the thing. The big thing is that in retirement, the money that's in the market is not money that you need. Okay? The money in the market is still designed for long-term growth. Your income needs taking care of something different. And so when you have that income bucket taken care of, you can let your money work and grow and employ strategy. And so yes, using whether it's a rebalancing or a sector rotation or an adaptive cruise control concept, those are the beauty of being independent. They're tailored to you. Now, some of you are thinking, well, Ben, I've never heard of any of this type of stuff before. That's why we have a system for this. We sit down with people every day, all day long, and help you, empower you with the information to make sure you make the right decisions. But here's the thing. It doesn't start with us. We know what we can do. On average, someone that employs the Retire Your Way system into their lives saves approximately about $500,000 more in assets over their lifetime. If that's worth picking up the phone, give us a call, 855-855-7655. That QR code right there will help you understand what you need to know about your money to be successful in and through retirement. We're not in accumulation anymore, folks. We help people that are 10 years away from retirement or already retired organize and structure the wealth you've accumulated, put it in the right tool for the right job. Now it starts with you. Pick up that phone, give us a call. We'll assess and evaluate if you have a need, and if so, we'll help you employ a plan to help you retire your way.
Ben, thank you so much. Matt, so glad that you joined us. Please come
Absolutely.
back for
Thank you
another
for having
show.
me. Been
I just
great.
wanted to ask you, we barely have a minute left or so,
Sure.
but with this market volatility, the clients that you're talking to, people you've had on board, are they scared out there, or are they comfortable because they've had somebody put a plan in place already?
I think that's a good point. What Ben and I really try and do is employ people, like he said, with the knowledge so that they know we're a partner in this together. Hopefully we've set the right expectation to say, hey, we've done an assessment with you, we know where you feel comfortable, and ultimately we've put them there. So they should kind of expect what we've experienced so far. So I will say most of our clients that are with us aren't panicking right now, because hopefully we've done a good job with educating them and letting them know what we're doing.
Matt, Ben, thank you guys so much. Folks, I know that you might be out there panicking about the market volatility. Please talk with a financial professional who can help you make sure that you don't run out of your retirement savings. Call Ben right here at 855-855-7655. For Ben and Matt, I'm Spike Spengel. Thank you so much for watching Retire Your Way, powered by Thrive. We'll be back again next week.